Welcome back to the deep dive. Today we have a very specific mission, and it's built around a question you shared with us. You've got some extra cash moved over to a brokerage account, and the goal for the new year is to really boost your passive income stream.
And we've zeroed in on a fascinating target for this. It's the Real Estate Investment Trust, WP Carey, ticker WPC. All the source material really presents this as a cornerstone for income. They promise a bankable income stream from a high-yield dividend.
That dividend really is the headline, isn't it? I mean, we're talking about a yield that just blows the broader market out of the water. But for anyone who's serious about passive income, a high yield can also be a bit of an alarm bell.
Exactly. Does that yield come with a ton of hidden risk?
Yeah.
So our deep dive today is all about checking that foundation. We need to know if the underlying structure, the stability, the financials, the growth, if it all really supports the claim that this is a rock-solid income play.
Or if it's just a flash in the pan. So the core question for you to think about is this. Once we dig past that impressive 5.7% yield, do we find a safe haven for your cash?
Or house of cards.
Let's start with what WPC claims is their operational superpower, the net lease model. So WP Carey is positioned as one of the largest players focused on net lease real estate. Okay, let's unpack that because it's a crucial structure. What does net lease actually mean on a practical level?
It's everything. It's the absolute bedrock of their stability. Think of it this way. In a normal commercial lease, the landlord is on the hook for all the variable costs: maintenance, property taxes, insurance.
And those costs can go all over the place, right? Especially with inflation or, a surprise tax hike.
Precisely. So a traditional landlord might have stable rent coming in, but their actual net income is always vulnerable. A triple net lease, which is what WPC mostly uses, shifts all that volatility. It puts it right onto the tenant.
So the tenant covers everything: maintenance, taxes, insurance, all of it.
All of it. For WPC, the landlord, their job basically becomes collecting a fixed rent check.
So they aren't really acting like a day-to-day property manager. They're more like a passive finance partner.
That's a great way to put it. That's the goal. And the result is this remarkably stable rental income, because WPC's exposure to those variable costs that can, sink other real estate ventures is just minimal.
And they apply this to very specific types of property, I noticed.
They do. They focus heavily on single-tenant industrial, warehouse, and large retail properties that are considered operationally critical.
Operationally critical. So that means the tenant can't just pack up and leave easily.
Correct. The building is essential to their business, maybe their supply chain. And if you combine that with the lease duration, the stability gets even clearer. We are not talking about short-term leases here.
Okay.
The weighted average lease term for their whole portfolio is currently 12.1 years.
12 years. Wow. That gives you incredible visibility into future cash flows.
It does. But you brought up inflation earlier, and that's a fair point. 12 years of fixed income sounds like it could be a problem.
Yeah, does that stability come at the cost of growth? Are you just getting eaten alive by inflation over that decade?
Not with their setup. The sources are very clear that these long-term contracts have built-in rent escalations. This is critical. Just in the third quarter, for instance, their same-store annual base rent grew at a 2.4% annual rate.
Okay, so they have an inflation hedge baked right into the contract. It's automatic internal growth.
It's resilience by design. And then you add another layer of security with diversification. Their portfolio isn't just in one corner of the U.S. It's spread across industrial and warehouse assets in the U.S. and quite a bit in Europe, too. That protects them from any sort of localized economic shock.
All right, let's pivot to the main event here, the dividend. The yield is high. It's sitting at about 5.7%, which, it just dwarfs the S&P 500 average of, 1.1%?
Not even close.
And a yield like that demands some serious scrutiny. If the foundation is so solid, why is the market pricing it with such a high yield? The question has to be dividend safety.
This is where we have to look past the usual metrics. For a REIT, looking at earnings per share it's pretty misleading. That's because of the huge non-cash impact of depreciation. We have to look at adjusted funds from operations, or AFFO. That's the real cash available to pay out.
Okay, let's be super clear for anyone listening. Why do we just ignore depreciation when we're talking about a REIT's ability to pay?
Because depreciation is really just an accounting rule. It's a non-cash expense that spreads a building's cost over time. But no cash is actually leaving the company's bank account. WPC owns real estate. And historically, real estate tends to appreciate or at least hold its value. It doesn't wear out like a factory machine. So AFFO and AFFO add that non-cash expense back, and that gives us the true picture of their cash flow.
Got it. So what does WPC's actual cash flow, their AFFO, tell us about the safety of that 5.7% yield?
It tells us there's a really significant margin of safety. WPC projected generating between 4.93 and 4.99 per share of adjusted FFO in 2025. Now you compare that to the dividend they're actually paying. The current annualized rate is $3.68 per share.
Okay, that's more than comfortable. If you're paying out $3.68 from almost $5 in cash flow, that's a huge buffer.
It's a crucial insight. The high-yield critics seem to miss this. The FFO doesn't just support the dividend, it easily covers it. They have something like a 35% cash buffer. That conservative payout ratio is a huge sign of financial discipline.
And it means if something bad happens, say a big tenant defaults, there's enough extra cash flow to keep that dividend stream secure.
Right. But it raises a good question. Why are they so conservative? REITs have to distribute most of their income. Why not pay out more and push that yield even higher?
Yeah, why keep that cash?
They keep it to fund future growth, specifically to buy more income-generating properties. And that brings us to the second pillar of their financial health, their balance sheet. That rock-solid balance sheet claim is backed up by their access to capital and their debt levels.
So let's put some numbers on that.
Okay, first, they have a solid investment-grade credit rating. That's key because it means they get cheaper access to debt when they want to buy those big properties. And crucially, their leverage ratio is conservative. At the end of Q3, it was 5.8 times. It's right in the middle of their target range.
A 5.8 times leverage ratio. What's a good analogy for that? Is that like having a manageable mortgage, or is it more like being maxed out on your credit cards?
It's very manageable. In the REIT world, you'll see leverage ratios get up into the 7s, 8s, even higher sometimes. 5.8 is a very disciplined, fortified position. It means they're not just borrowing aggressively to make ends meet. So you have this combination: stable cash flow, a big coverage buffer, and low leverage. That's the real engine behind the high yield. It's a system built for the long haul.
Okay, so the dividend is stable, it's well fortified, but like you said, they are holding back cash for growth, and stability isn't enough for a long-term investment. So let's shift to those growth drivers. What is WPC actually doing to make sure that income stream grows over time?
Well, the growth engine has two sides. There's internal growth and then external. Internally, it comes back to those lease escalation clauses we talked about. They have this sector-leading same-store rent growth that's basically on autopilot. That 2.4% rate, that just happens because the contracts say it will.
That's the foundation. But the external growth, deploying billions of dollars, that's where the real opportunity is, right? And maybe the risk, the source materials point to a pretty aggressive investment strategy.
Oh, absolutely. Their strong financial profile lets them be really opportunistic. And that external growth comes from three main places: buying existing properties, building new ones for specific tenants, and a special transaction called a sale-leaseback.
Sale-leasebacks are really interesting. So they buy a property from a company and then immediately lease it right back to them.
Exactly. It's almost like a financing deal that's wrapped up in real estate. It gives the company a bunch of cash, and it gives WPC a long-term, operationally critical tenant locked in from day one. And they are executing this strategy at a huge scale. WPC was on track to invest between $1.8 and $2.1 billion in 2025. That is a massive commitment to expansion.
And they're getting it done. By the end of Q3, they'd already secured $1.6 billion of those new investments, and that new capital flows directly into growing the adjusted FFO.
Which is exactly why they forecast that AFFO growth of between 4.9% and 6.2% in 2025. That fast pace of FFO growth is what lets them keep raising that dividend, which grew 4.5% over the past year. It's a very clear line from capital deployment to shareholder returns.
But funding $2 billion in new properties requires a lot of capital, and this is where their strategy of capital recycling comes in. It seems like a brilliant move, but also one that maybe introduces some temporary risk. What is capital recycling exactly?
Capital recycling just means they're constantly pruning their portfolio. They sell off properties that are no longer core to their main strategy, which is industrial and warehouse space, and they immediately take that money and redeploy it into higher returning net lease properties that do fit their strategy. It's about optimizing the asset mix.
So they're trading lower yielding, non-strategic assets for higher yielding core assets. What kind of scale are we talking about for these sales?
The scale is immense. This isn't just a little bit of house cleaning. They were on track to close between $1.3 billion and $1.5 billion of sales in 2025. And a really specific example of this was them selling 37 of their self-storage properties for over $500 million.
Okay, so selling self-storage to fund industrial acquisitions, that shows a really clear strategic focus.
Absolutely. And they still have this huge pool of future capital just sitting there, ready to be recycled. They still have 42 operating self-storage properties they plan to sell, plus other non-core stuff like a valuable stake in a cold storage REIT called Lineage Logistics. This gives them huge financial flexibility.
Meaning that they don't have to go to the market and raise new money if conditions are bad.
Exactly. And looking ahead, that pipeline for growth isn't slowing down. They've already locked in 6 more investments, about $181 million worth, that are set to complete by early 2027. That kind of visibility is gold for an income investor.
Yeah, that suggests a really well-oiled machine.
So if we pull it all together,
Mm-hmm.
the investment case for WPC really relies on this triple threat. You have a dividend that's high yield but low risk because it's protected by that huge FFO buffer. You have predictable growth from the built-in lease escalations. And you have this amazing financial flexibility from capital recycling.
So what does this all mean for you as you're thinking about where to put that cash? The source materials are arguing very strongly that with WPC, you're not trading safety for a high yield, you're getting both. You get the defensive, long-term stability of the net lease structure, and you get a management team that is laser-focused on reinvesting capital into higher-returning properties. The foundation isn't just solid, it's primed for more growth in 2026 and beyond.
But this does raise a really important question for the track over the coming year. It's about that capital deployment. The company has a ton of capital ready to be recycled. Those 42 self-storage properties, the stake in Lineage Logistics. Now, given how strong their deal pipeline is and their target leverage, what are the short-term risks or opportunities as WPC actually makes that shift? I mean, selling those assets is only half the battle. The real test is how efficiently and how quickly they can deploy that specific cash into new income-generating properties. That deployment process, that's the next big thing to watch as you monitor the REIT's path forward.